And today's episode is brought to you by our sponsor, Diag Partners, staffing and recruiting that moves at the speed of your business. Visit them today at diagpartners.com. Welcome back to In the Harbor. I'm your host, Jason Johns, joined by my co-host, Scott Lindsay. And Scott, today's guest is someone you're particularly excited for.
I'm actually pretty excited to have today's guest on the show. I had the opportunity about a decade ago to spend some time with him and really helped shape my views of the market. So I'm excited to see where he's at, what he has going on today.
Excellent. So today's guest is Joe Zidle, founder and CIO of Zidle Macro Strategy Group. Before that, he spent nearly 8 years as Chief Investment Strategist at Blackstone's Private Wealth Solutions business, one of the most influential macro seats in the industry. Before Blackstone, he was with Richard Bernstein. Before that, Bank of America, Merrill Lynch, Ned Davis Research, and got his start in the U.S. Army, specifically military intelligence. So I think there's an interesting story there. Joe, welcome to the podcast.
Well, thanks very much for having me. I look forward to the conversation. Scott, good to see you. It's been a minute or two.
Oh, it has. Great to see you, and appreciate you taking some time to join us on In the Harbor today.
So, Joe, why don't we dive into it? You know, something we've uncovered in a lot of these conversations is this non-linear career path. And I know you've had a non-linear career path, so maybe let's start at the beginning.
Yeah, well, thank you. And I think if you were to look up non-linear career paths in the dictionary, it might be a picture of me because this all started when I guess I was so I was born and raised in Southern New Hampshire. I went to Emory University in Atlanta, Georgia. And after my freshman year, I had to figure out a way to pay for the rest of school. And so I went into a U.S. Army recruiting office, and I enlisted in the Army Reserves. And in exchange for an 8-year enlistment in the reserves, so 6 years of active reserves and 2 years of IRR, the Army gave me the GI Bill, which then got me through the rest of school. So while a lot of other people were doing interesting internships and sort of laying the foundations for a career in finance, I was spending my time between Fort Leonard Wood, Missouri, Aberdeen Proving Grounds, Maryland, Fort Benning, Georgia, Fort McPherson, Georgia, and spending a lot of time out there in the field under the umbrella of military intelligence, ground surveillance, and reconnaissance.
That's amazing. I mean, that is the ultimate internship, though.
It was an internship in how to eat food in the rain. The benefits of Tabasco sauce. I learned in the Army Reserves that Tabasco sauce makes everything better.
Tabasco's your best friend?
They get little bottles that come in each MRE packet for you.
They sure do. And to this day, I still have bottles of Tabasco sauce sitting in my refrigerator.
You know, and the Emory undergrad is interesting because, there's a lot of top financial minds that came out of Emory. You have Rick Rieder, who was almost the Fed chair. He also did undergrad at Emory.
Yep, that's right. And we found that there is a group of us in New York. I found a number of Emory alums at Blackstone and then across the industry. And it was always interesting. I've had a couple opportunities to sit down with Rick and to share that common history.
Oh, that's great.
No, Rick's great. I know, obviously, you're a big fan of Rick Rieder. I'm spending some time with BlackRock with him. So while you were at Emory, Joe, you were studying economics and history. That tends to seem to be a common a pair up, but maybe walk us through a little bit how both of those paths kind of led you to where you are today, kind of laid the groundwork.
Yeah, well, first thing I'd say is they were definitely both passions of mine, and so for me, it wasn't necessarily about having that 3 or 5 year plan. I don't actually think there's ever been a time in my career where I've had a 3 to 5 year plan of what I wanted to do. I always just tried to follow the things that were most interesting to me or the things I was passionate about. I love history. I've always loved history to this day. whatever book I'm reading generally has, some historical ties to it. So I'd always been an avid fan of history, that I found history and economics paired really well. And for me, it was about sort of like, how do solve puzzles, and how to arrange pieces of a puzzle on a table in order to put together, the picture. And in a lot of respects, military intelligence was like that as well, right? So my job, my role in the Army MOS was ground surveillance reconnaissance, and you can kind of think of that as collecting intelligence, where you have fractional information, and you're doing that in heightened uncertainty. And so for me, I found the kind of the through line here, the common through line between economics, history, and military intelligence was always about trying to look at the data that's presented in front of us, the data that we have at hand, not the data that you wish you had, but rather what presents itself, and understanding how to form a picture or an understanding of that. So for me, history and economics were about sort of trying to solve those puzzles, and I guess I didn't plan it this way, but I guess my role in United States Army Reserves was somewhat similar.
And almost foundational to your work throughout your career.
And sometimes when you look back on a career, you look back and say, okay, that makes sense. But I can tell you, in the moment, I definitely didn't have that vision or that plan.
So I'd be curious, if we look at economics and history, which kind of line of study do you feel like you use more? I mean, they're closely related, of course, but
yeah, it's an interesting question, and I've always looked for like the biggest historical pictures in my work. And so when I'm working with data, in terms of investment strategy, whether it's building models, building charts, running regressions, I've always tried to understand what are the biggest historical pictures. And so from that perspective, I think I probably lean on history a little bit more than economics. And it helps me frame my thinking. It helps with the storytelling. And, I know we'll get to current events in a little bit, but if we think about where we are with AI today, I think history of, other revolutionary and evolutionary technologies is really super important as we think about the build out of AI in the United States, because we think about, what are the historical analogs? The amount of spending on AI today has vastly exceeded the tech spending in the 1990s. It's vastly exceeded the electricity spend from 1900 to 1930s, and it's rivaling like the railroad CapEx build out in the 1870s to 1890s. So, even today, when I think about AI, I find myself really, leaning on history to understand that broader kind of historical perspective. And probably, economics obviously plays a role there. But for me, I always think about what is that biggest historical timeline? A fun example of that is a couple of years ago in 2020, before the Fed hiked rates, we were at the lowest global interest rate in the history of the data. And it turns out the data goes back 5,000 years. And so I read a super interesting book by Edward Chancellor called The Price of Time, which is a 5,000-year history of interest rates. Now, I say super interesting. You have to love interest rates in order to love
I was going to say.
But, you talk about that historical framework, it traces interest rates back to Mesopotamia, 3000 BC. So I got to think, is that the economics, sort of mind of mine, or is that the historic sort of like mind of mine? I would definitely say it's a little bit more history than economics, because I don't know what Mesopotamia, interest rates in Mesopotamia actually mean for us, other than it puts together a killer chart.
Well, and that lends itself to the military intelligence side of things. We're kind of forming an idea based on incomplete information. So history is just giving you one variable, right? Of course, all the variables change when you try to apply it to something backward looking.
Yeah, absolutely. And I think the historical perspective and understanding the track record, for me, ends up being part of that foundational knowledge. A lot of times when we're faced with data and we're trying to make the most of it, one needs to think, what's the true north on this? If we just take this data point, if we take this 3-month trend or 6-month trend and annualize it, what is it telling us? Well, let's go back to first principles. What are those foundational things that we know? And so for me, understanding the historical cycles, the economic cycles, the business cycles, political cycles. Each one of them are separate cycles. They each work on their own timelines. Political cycles every 2 to 4 years. A business cycle is every 3.5 years. An economic cycle averages about a little over 7 years. Each one of them has their own drivers, their own speeds. And so I use a lot of that historical perspective just to really help, kind of lay the foundation, help me establish what is, kind of that true north on my views.
Absolutely. And getting into your career a little bit. So let's walk it back to Ned Davis Research. Then was it Merrill Lynch, B of A?
The Merrill Lynch, yeah.
And then Richard Bernstein and, of course, Blackstone before founding Zidle Macro Strategy. So I'd be curious to hear kind of what helped shape your career at each of those stops.
Yeah, really good question. And, I would say a couple things. Number one, regarding the stops, like I said, I didn't necessarily ever have a plan. I had the opportunity to go to work at Ned Davis Research. Ned is a historian. He is a technician. He is someone famous for putting fundamental data into picture book form. He's written many books on the markets. And, for me, some of my most basic and most important lessons in finance and in life really emanated from my time working with Ned. One piece of advice Ned gave me, and I've shared this all throughout my career, is he once said to me, if you have a problem that can be solved with money, then it's not a problem. And I've used that a lot in my personal life. I can remember one time being in Miami, Florida, right before Valentine's Day, giving a speech at one of the most beautiful hotels right on the water. And I got done with my talk. I called my wife, who's at home in New Jersey, and it was about to snow, and she was talking about having to shovel the driveway out. Meanwhile, I was at the Fontainebleau, overlooking the water, having just given a speech, and it was 2 days before Valentine's Day. And she was telling me how she was going to have to shovel the driveway. And I started thinking, wow, okay, what do I do? I'm at the Fontainebleau in Miami. She's going to be shoveling on our house in New Jersey. Ned's advice, if you have a problem that can be solved with money, it's not a problem. So I started thinking, I've got to get her something really nice. Maybe something like a new red shovel or something like that to really make up for it. So fortunately, I did a little bit better than a red shovel because we just celebrated our 25th anniversary. But I think about my time working with Ned. He was a historian, he was a technician, incredible thinker on the market. When I was working at Ned Davis Research, I had an opportunity to join Merrill Lynch up in New York. And so I moved up to my wife and I moved from Atlanta up to New York, and I joined Merrill Lynch, working as a kind of an equity research person on the trading floor. And so if you think about what that role was like, I was sitting amongst the traders at Merrill Lynch. And whenever an economic data point would come out, whether it was something like, PMIs or initial jobless claims or monthly non-farm payrolls, I would build a quick model, run a regression, put together some data, give it to the traders would send it out. And then I moved into the research department. Rich Bernstein was the chief investment strategist, and he was looking for to replace his number two, who had gone on maternity leave and decided that she was going to be a stay-at-home mom and raise her 3 kids. And so Rich needed a kind of a junior, and so he hired me up into the research department. And then I made the shift from an equity desk analyst on a trading floor to Merrill Lynch's global research department. And there I worked with Rich. He left, and I ultimately became chief investment strategist, and I ran Merrill Lynch's tactical and asset allocations. And then after he left, he started his own firm, Richard Bernstein Advisors, and he and I got back together again, and I went to work for him there as a portfolio manager and chief investment strategist. And so Rich was really my boss over the course of for probably 12 out of 16 years across 2 firms, both Merrill Lynch and Richard Bernstein Advisors. In 2017, I got a call from Blackstone. It was Byron Wien who said, come on in, grab a cup of coffee. And I thought, wow, I'm going to go and have a cup of coffee with Byron Wien. Byron was a legend in finance. He was, at the time, 83 years young. And what I learned was that he had started to think about his successor. Because I guess somewhere around the age of 83, he started to think about what he wanted to do with the rest of his life when he grew up. And so Blackstone drafted a list of potential successors, and they went about calling people. I think they called 25 people in, and I was one of them. I sat down, had a cup of coffee with Byron, and I thought, this is it. I'm done. Now, in classic Blackstone fashion, that meant 11 months of interviews, over 20 rounds, and multiple dinners. But ostensibly, he had me at hello. So I joined Blackstone, worked alongside Byron, and ultimately succeeded him, and to become chief investment strategist within the private wealth division of Blackstone. And it was an incredible learning opportunity because I got to learn, sitting side by side with Byron. And then I sat on the investment committees of real estate, private equity, credit, infrastructure, tactical opportunities, and a number of other businesses. And so I really had some of the best training on alts, out there in the industry. And so if I'm to kind of look back across Ned Davis, Rich Bernstein, Byron Wien, I guess the way I would think about it is, if my career ended today, it would be an incredibly fulfilling one, because I've had the opportunity to really learn uh, from what I consider to be some of the absolute best in the industry. And for that, I'm incredibly fortunate. I've enjoyed every minute of it. And like I said, I don't think I ever really had a plan. I was just always looking for a couple things. In my career, I was looking, number one, to work with smart people, number two, to learn, and number three, to work on something that's core to a business. And I've been very fortunate in my career that I've been able to find some combination of those three. At times, I've had all three, and that for me has been the most fulfilling part. And that overshadowed any plan, any vision or whatever that I might have had for my career. It's just always, well, how can I work with smart people, learn and work on things core to a business?
Well, and I think there's a valuable lesson in that career arc as well, that, you have to continue doing great work to be noticed outside of the firm and be in a position to get that call, one of 25 people.
Yeah, for sure. And, maybe I've sometimes thought, how is that? How did it come to be? And I think the best explanation I can come up with is that um, my last name is Zidle, and they exhausted every other possibility. And they're at the end of the alphabet, and they're like, okay, we're stuck.
There weren't many Z's left. Well,
So, Joe, you've had,
exactly.
as you said, amazing career, opportunity to work with some of the titans of our industry in terms of research. Rich is a data maven, the private markets with Byron. At what point, was there a seminal moment for you that, I know you don't have a 3 to 5 year plan, but when did you start to think more in terms of your view on macro strategy versus the views of others?
It's a really good question. I've always thought, okay, so I've got this non-traditional background, right? Small town in New Hampshire, in southern New Hampshire. Emory University, United States Army Reserves, and I didn't have the traditional internships that other people would have had, that other people did have. But I always felt like, okay, I've got a seat at this table, and I want to contribute. And so I don't know that there was ever a point where consciously I said, okay, I'm going to have my own views and I'm going to start doing it this way. Rather, it was sort of thinking about, like, I've got this seat at the table and I've got opinions, I've got thoughts, and let's go ahead and test these. Let's push a little bit and let's push back. And I've always thought about, and this is something that uh, you would hear a lot at Blackstone, which was disagree, but don't be disagreeable. And so I've always looked at the data and thought, how do I think about it? What's my argument? What's my base case? And where I've had an opportunity to have a seat at that table, whether it's the boardrooms inside of Blackstone or the investment committees with Rich at Richard Bernstein Advisors, or prior to that, it's when we were the investment strategy team at Merrill Lynch. I always thought, I'm going to lean into this. And so I don't know that I consciously ever said, I'm going to develop my own views, but I always consciously said, I'm going to lean in and let's debate this and let's argue the point. Let's get to, a more fulsome sort of view or truth on these things. And so what I learned was that I can bring this historical data to the table. I can bring this, kind of bigger historical picture, and I can have an opinion and have a view. And over time, impact, hopefully positively, an investment committee or an investment strategy. So I would say if someone's out there thinking like, hey, when do I start to contribute? When do I start thinking about these things and start to chart my own course? My answer to that person is just lean into the conversation. lean into the dialogue, because I've always considered the following to be a criticism. If someone says, well, wait, we haven't heard from you on this subject, that to me is a bit of a criticism, because I want people to hear from me and I want to be able to contribute to that. And so my advice to others is just make yourself heard.
And we'd like to take a second to thank our sponsor, Diag Partners. We've worked with Diag directly at Rock Harbor, so we know firsthand they deliver. If you're running a company and have a seat to fill, or you're a professional thinking about your next career pivot, these are the people you want in your corner. From analysts to executives, placements done with speed and discretion. Check them out today, diagpartners.com. So, and thinking about that, because you've headed a lot of committees, are there any particular instances that stick out where maybe you had one belief and the subcommittees within the investment committee kind of swayed you to their thinking?
Yeah, it's a really good question. I'd say one thing that I've always felt is very important in an investment committee environment is that everybody has the same facts. And it's something that Alan Greenspan used to talk a lot about, the idea that, everyone can have their own opinions, but not their own set of facts. And that was a discipline that I've seen in investment committees. And then as I grew more senior in the industry and started to run more investment committees, that was something that I always tried to enforce, which was we're all going to work off the same investment committee playbook or the same investment memo. And we can all have our own opinions on that. But the thing that I wouldn't allow is someone walking into the investment committee saying, but wait, here's this other data, and you haven't seen this yet, but I think it's really important. It's not to say that we wouldn't include other data, but that other data, if we're going to include it, needed to be agreed upon by an investment committee and needed to be circulated in advance. And so if I think about the tension between my views and investment committee member views, there's been plenty of times where that sort of ebbs and flows. It goes back and forth. But it was always rooted in the discipline that we're all going to have the same facts, and we should all have our own opinions on those facts. So I can't think of a particular time when I was necessarily overruled or swayed, because I would say there's probably too many to count or too many to remember. But it was always the discipline that we're going to work off the same playbook. And let's go ahead and argue that data. But it's got to be a set of data, a framework that we've all seen in advance and agreed on.
Oh, that's a great answer. I appreciate that. Jumping into Zidle Macro Strategy, maybe let's talk a little bit about what you're seeing, because the macro environment right now is pretty interesting when we start thinking about trillion-dollar IPOs. And that's, I think to put it into context, the first trillion-dollar market cap company was Apple, and that was only Q4 of 2018. And so the world's changed a lot since then. And we're just talking over 7 years.
It is incredible. I would say a couple of things. Number one, I think this is a really exciting time to be an entrepreneur. I left Blackstone at the end of September 2025. And I had my mandatory non-compete program. So I couldn't work. And this is a time when AI was really exploding. If 2025 was the year of the models, 2026 has been the year of inference, or so people thought. Well, it turns out 2026 is the year of the agents. And so as I was at home on my non-compete, I realized, a couple things that I was good at and a whole lot of things that I was not good at. First thing I'd say is, for the first time in my career, I was home in the morning to get the kids off to school. That was a disaster. From 7:30 a.m. till 8:30 a.m., when I went downstairs thinking I was helpful, all I was doing was upsetting everyone in my family, getting myself yelled at. So I turned into a semi-professional dog walker because I realized that's how I could help. Because with teenagers and with a wife who's a public school teacher, from 7:30 a.m. to 8:30 a.m., there was a routine. I'd never seen it before. When I saw it for the first time, I thought, I can optimize this. I can help out. Turns out I wasn't so helpful, not unless you want your kids going off to school having been yelled at and crying. So I started diving into AI, um, building agents, having those agents connecting via APIs to data providers, pulling down data, building models, running regressions, doing analytics, doing the type of research that my research teams across Merrill, across Richard Bernstein Advisors, Blackstone were doing, and these agents were doing at an incredibly high level. And so it was a combination of things, right? So number one, I had time to think about what I really wanted to do. And number two, I could stand that up agentically with AI. And so I thought this is an incredible time to be an entrepreneur. So I launched Zidle Macro, which is an independent investment strategy firm. We do senior advisory for GPs. We do outsourced and fractional CIO for LPs. And I have a subscription-based newsletter. And the where we are today at the intersection of this incredibly interesting and quickly evolving macro environment, the democratization of private markets, investors trying to understand how private markets impact public market portfolios through asset allocation and things like that, and the uncertainty around interest rate policy and a new Fed chair. You put that all together, and I think it's a really incredible time to be out there, and for me to be out there as an independent investment strategist. And so for me, I think it's really exciting. I'm having a lot of fun doing it. I've got a really strong team of agents and sub agents. There's about 30 sub agents that I'm running that are working just about 24 hours a day, 7 days a week, doing incredible amounts of research, and we're looking at a really exciting market. And I'm doing that through the lens of 25 plus years of public markets, and the last nearly 8 years having received among the best private market training that one could ever hope to. So for me, it's a really sort of the white space here is putting it all together in terms of an independent investment strategy, and doing that with agentic AI. So I think it's a super exciting time. Funny, one of the things I wrote about was people starting businesses and looking at the number of business applications, which continues to hit all-time new highs. And you think, why are people going out starting their own businesses right now? One theory is it's stress, right? Because we know that it's been a really tough jobs market, particularly for younger, highly educated people, recent college grads. We know that it's a really tough labor market for recent college grads. So maybe because they're being sort of maybe because they're having a harder time in the traditional job market, they're going starting their own businesses. So one theory is business formation is up because of stress. Well, we saw stress after the great financial crisis, the GFC, and business formation was not up, it was down. I think the message on business formation is it's an exciting time to be an entrepreneur.
Well, and I would argue too, with AI and everything we're seeing, it's so much more efficient to start your own business, assuming you know how to use the technology and you're using it correctly. I mean, we had Susan Frew on, who she had a HVAC company and turned basically everything over to AI, from bookkeeping to marketing, and then was able to scale and eventually sell the company. And now she travels around speaking on AI, but I think that might be part of the reason, where before you might need 5 or 6 people to do something one person can do.
Yeah, that's exactly right. I was after I left Blackstone, I was interviewing at a number of Blackstone's peers and competitors, and in one conversation with the CEO of a company, he asked the question, what size team would you need to hire here in order to operate at the highest level like you had, previously in your career? And I said, 0. And he was sort of taken aback. I said, well, let me explain. I'm running 6 agents at the orchestration level. Each one of those agents is running 5 to 6 sub-agents as teams. The teams do the research, they do the models, they run the regressions. Teams do quality control. Other teams do fact checking to ensure accuracy. I have teams that go out there or sub-agents that scour all of my Excel and Python code, looking for broken links, looking for quality control issues, looking for hard-coded cells. and they're operating at an incredibly high level, and the cost of that works out to, dollars per day when you start thinking about the token costs. And so when you think about the efficiency, I think it's really incredible. Now, over the last 6 months, there's been this SaaS apocalypse, right? Where a lot of these software companies got absolutely crushed. Ordinarily, I would have been pretty skeptical about that. But when you start working with the more capable agentic models, and you have a question for a model, and the model says, well, go out, sign up for this company's 14-day free trial, screenshot anything you like, and send it back to me, and I'll build it. You realize just how disruptive this could potentially be. So disruptive to software companies that are a thin user interface, but like the HVAC example you mentioned, it could be transformative to other types of businesses because of the efficiencies. So I think it's an interesting time. We're coming, we're in phase one right now of the builders. So you think about the hyperscalers of building installs capacity. Typically, there is some catalyst. That catalyst then causes the market to shift from phase one, which is the builders, to phase two, which are the adopters. And you typically have these two very distinct phases. They produce very different sets of winners. And there's usually a catalyst that causes you to shift from one to the other. The catalyst in this case are the price wars that are starting to break out. And so if you think about that historical analog, in 1900, there was a guy named Samuel Insull from Ohio who saw electricity and thought, this is the future. I'm going to build electricity in the United States. By 1930, he was the single largest electricity owner builder in the United States. He owned 12% of the electrical grid in the United States by 1930. By 1932, he was bankrupt. Ford saw cheap electricity, and they re-engineered their entire business around cheap electricity, and they dominated for almost the next 100 years. So you've got the builder and you have the adopter. At some point, there's a catalyst that causes you to shift from one to the other. Catalyst is the convergence of price drops. The cost of switching is near zero, right? The cost of switching from one model to another is simply a configuration change. And then you've got a revolt among users, right? Where you had companies like Uber who announced, that they'd spent their entire 2026 token budget by April. By April, in 4 months, they'd used an entire year's worth of tokens budget for their tokens, and that they said they couldn't justify the expense anymore. So you have the convergence of, sort of this capacity that's been built. You've got sort of like the cost to configure, your cost of switching models goes to zero. Then you have the revolt around users who are saying, wow, this is really expensive. We're going to look for lower cost options. Lo and behold, Microsoft announced that it was exploring the incorporation of DeepSeek, a low-cost Chinese model, to incorporate into its Copilot software in order to lower costs, right? That's the price war, but that's also, in my mind, that's the starting gun. We're off to the races. Now we're going to start transitioning to the companies that adopt this. And so whether it's the HVAC company that, uses AI to take the place of 4, 5, 6 people or whatever it is, I think we're going to start to see the next phase of this is going to be the adopters who build their companies around AI that are going to win.
More companies like Allbirds.
I don't know enough about Allbirds. I just read the headlines. That one, no offense to Allbirds, but I would have to look at that one pretty skeptically.
I'm sure we'll see. Yeah, I'm sure we'll see more of those come out. As there are a lot of parallels to the lead up to the .com bubble.
And then think about the foundation that all that tech spending, built. That foundation gave rise to Netflix, to Google, to, all these other incredible companies. And you can think about every single one of these revolutionary technologies. Phase one is the builder, phase two are the adopters.
And, one thing that's interesting when we talk about all of the spend, specifically the infrastructure spend from the big AI companies, I wonder what could be a left tail event that could kind of throw that awry. For instance, Elon Musk was talking about data centers on the moon. And I think he gave a timeline around 30 months.
Yeah. I would not bet against Elon Musk. Maybe
right,
not his timing, but his direction.
So what would that do to the build out of the data centers on land? Because they were talking about how much more efficient they would be on the moon, and solar power is much greater. So it could make them obsolete after this huge spend.
Yeah, well, I at first I have to confess to being a total Elon Musk fanboy. Let's just get that on the table.
Well, everyone should be. He just keeps winning.
Yeah, if we have to show some disclaimers a little bit later, saying that you don't disclaim, you don't, you totally disclaim everything I said. Fine, we can go through disclaimers. But I am an Elon Musk fanboy. I think I saw SpaceX is selling a T-shirt that says "It's always sunny in space" or something like that, right? Because he talks about the how solar power is so abundant up there, and you don't have clouds or rainy days. So the question is, what are the left tail events? And I'd say there's a couple. And I think we're starting to see a few of these playing out. The first left tail event, I think, is something that the market is beginning to understand, and that is AI is inflationary. And it's not supposed to be that way, right? AI is supposed to deliver productivity. Productivity is supposed to be deflationary, but we're seeing the exact opposite. And the reason why is because if we look at that CapEx spend, on order of, call it $750 billion in 2026 is the estimate from the hyperscalers. When you zoom out a little bit and you think about the second and third tier players that are supporting the hyperscalers, you're talking about over $1 trillion of CapEx going into the ground. And if you think about that CapEx, what you're talking about is it is commodity intensive and it is labor intensive. And so the build out to all this stuff is enormously inflationary. And we're seeing that in numbers. And it is not transitory. It is not this quarter, next quarter, then going away, because the build out is going to continue in 2027. I think it will continue in 2028 as well. And my guess is we're going to only continue to build more as AI continues to evolve. So what does it mean that it's commodity and labor intensive? You're moving dirt. That requires a lot of commodities. It requires a lot of, construction equipment, moving dirt, pouring foundations, concrete, all those commodities go into it. Massively commodity intensive. And how labor intensive is it? Well, we can go into the data, but the headline says enough. Meta and Google combined have committed $160 million to construction jobs training. Meta and Google historically do not produce construction workers. Historically, they're producing things like AI. But what does it say about the marketplace when they are training construction workers and electricians? It tells you you have a massive shortage of construction workers. The number is about 439,000 construction worker deficit in the United States currently. So it's labor intensive. So it's inflationary. Left tail risk number one, it's inflationary. And we've seen that where the market was coming into 2026 thinking interest rate cuts. Now the consensus is turned toward interest rate hikes. And I think we'll see at least 2 hikes. I think that's the floor, not the ceiling. Another left tail risk is what the United States government announced with respect to Anthropic, which was they forced them to pull their Mythos class model, which is Fable. And what happens when the leader in global AI withholds its frontier models from the marketplace? It abdicates that leadership and it opens the door for other model producers and providers, particularly the Chinese. Z.ai announced literally, I think the next day, the open source GLM 5.2 model for free in response to the restrictions that the US government had put on Anthropic. So now the frontier models are coming out of China and they're cheaper. So that's a left tail risk, political miscalculations. The third one you mentioned is what happens when we go into space. My guess is I take a page out of the Jevons paradox playbook, which is you lower the cost, you increase the use case, right? So I think what we'll do is just continue to increase the use case. So I worry a little bit less about that. I worry more about, say, the cost of political miscalculations.
So we've been running through, you've mentioned a lot of stuff. We've talked about the size of companies coming to market, what happens with AI. A lot of things have changed in the markets. My question to you is a little bit more philosophical, but we all know the 5 most dangerous words in investing. This time will be different. are we getting to a point where that actually might hold water?
That's a really good question. We talked about how I'm a student of history and I'm grounded in history. So that phrase that you mentioned, Scott, this time will be different. That lives rent free in my head. I think that this is the most revolutionary technology that humankind has ever seen. But the reality is, in that statement, there's an inherent look back bias, right? Which is to say, in the 1870s, railroads were the most significant technological evolution that had ever been seen in human history. The 1990s, technology, the internet, right, was the most revolutionary technology we had seen in history. And so what we find is that we've seen these revolutionary technologies in the past, but we have this inherent bias where we think, okay, this is the most advanced. Well, it's true, but 30 years ago, when you could get that AOL disk and get 5 hours of internet for free and use it to look up Letterman's top 10, that was the most revolutionary technology we'd ever seen. By the way, if you're curious, AOL at its peak had about 30 million dial-up customers, late 1990s. They wound down their dial-up service this past September. So up until September 2025, if one wanted, they could still have dial-up AOL service. Just before it went out of business, I grabbed an AOL email just because I thought, hey, I'm leaving Blackstone. Wouldn't it be fun to apply for jobs using an AOL email address?
Show
I
your
didn't
age.
get a lot of hits.
You got a lot of head scratching, though.
Someone's
bot is all
My
screwed
idea
up.
of fun is not the same as other people's.
No, I feel like most people's parents still have their AOL address, which was their first email address.
My father-in-law is notorious. He still turns off his phone when he's not using it to save battery.
Incredible.
And a quick message from our sponsor, Diag Partners, who makes everything happen here on In the Harbor. Hiring the wrong person is expensive. Diag Partners exists to make sure that doesn't happen. They move fast, they're selective, and they get it right. Whether you're hiring or looking, don't leave it to chance. Visit www.diagpartners.com.
So going back to your question, Scott, the idea that this time is different. The advocates of that will say that we've never simultaneously replaced, physical labor and intellectual capital at the same time, and that's what AI is doing. And Elon Musk presents a very simple argument along these lines. They're building the Optimus robot. He shut down production of the Model S and the Model X in his factories in order to make room for the robot production. And the Optimus robot, he argues, can work 24 hours a day. So he argues he can do the work of 4 people, right? 4 shifts, 24 hours. And then with AI, he argues it's going to be more productive. So it's really going to do the work of 5 people, not 4. So there's about 125 million people in the United States today that do production and services work, right? So think about the production and services side of the economy. It's about 125 million people strong. The rest of the labor is, government workers, stuff like that. So Elon's argument is with 25 million Optimus robots, he can replace the work of 125 million people. And he's laid out some arguments that says by 2030 or 2032 or something like that, he could do it. I don't know the answer to that. I think it's something phenomenally interesting to think about. And then when you scenario plan it, give it, say, a 5% weight. What if there's a 5% chance that that's right? What if it's a 2% chance it's right? How do you allocate and provision for that? I think that's going to be one of the most interesting questions we face over the course of the next couple of years.
Yeah, I would agree. I mean, there has to be some downtime for the robot, though. It can't work 24 hours a day. You have to oil the parts.
What about vacation?
Sick time?
Yeah. And as the machine learning goes, they're going to start wanting vacation. Then they're going to unionize. there's all
Exactly.
kinds of headwinds there.
So, Joe, when we see these times in history, right, and obviously you brought up Ford would be a great example, right? The assembly line, increase in efficiencies, right? And when we see these economic events happen over time, where do you think a likely place that those 125 million workers have opportunities to pivot to?
It's a really good question. My best guess, and here's where we again think back to what has history taught us about other revolutionary technologies. At the turn of the century, there were a couple million, turn of the century meaning 1900, there were a couple million people in the United States that serviced horses, taking care of horses, whether they were the horse and buggy drivers, the feeders, people who cleaned up after them, etc. I forget the exact number. It might have been about 3 or 4 million people in the United States in that industry. Today, it's under 40,000 people that do that. So if you start thinking about what are the jobs that didn't exist the generation before, right? So not the monthly non-farm payrolls, or what are new jobs that never existed before, what you realize is that the US economy is incredibly dynamic. From 1940 to 1980, the vast majority of new jobs in the United States, jobs that didn't exist before, were middle income production, because we were still a production-oriented economy, but middle income clerical, because people started going to offices for the first time. And that was an entire class of job that never existed before. From 1980 to 2020, if you look at the new jobs that never existed, they were really highly bifurcated between low pay services and highly paid services. Think about the rise of the accountants, the consultants, the investment strategists, right? Those jobs didn't really exist before either. And so the optimistic person inside of me is going to say that we will create jobs that never existed before, that we can't even possibly fathom. But I will say, full disclosure, I am an optimist. Choose optimism. I choose optimism. I think optimists, I think some people say they live better lives. Some people say they're more tolerable to be around. Being optimistic is good for a portfolio. So faced with uncertainty, I do choose optimism on this.
Well, and thinking about that, I saw a study of Gen Z on careers they want to have, and I think 2/3 came back saying influencer. So that's a job, that's relatively recent.
Yeah, my daughter is studying economics and political science, and she just got her Excel certification, and then she came home, and I was showing her my agents in the model building, and she said, "Well, Dad, what am I supposed to do?" And so I thought, well, be an influencer. The alternative is, if you are the generation that makes itself AI native, I think you'll have an advantage over the generations that simply use AI as glorified lookup. So the answer to my kids, my daughter who's a rising sophomore in college, my son who's a rising junior in high school, my answer to my kids is learn AI, figure it out, be AI native, and at least create the optionality.
Well, and the funny thing is, you have these folks, right, the younger folks that come in, my kids, they're anti-AI, right? So you'd think the younger generation on the cutting edge, they grew up with an iPhone in their hand, a computer, and the internet has been every bit a part of their life. And they're not just apprehensive of it, they're absolutely against it, right? So how do you kind of, I don't know if you've come across that with your kids, or how do you broach that subject? Because I think you're right. I think you need to lean in. I think the benefits of AI have already been proven. Maybe the investing side of it is still a little bit of a mystery, but increase in productivity and production, how do we kind of handle that negativity from the most important generation, is the ones that are entering the workforce today?
Yeah, and it's clear that they're coming at it from the point of being nervous and thinking about those unintended consequences. I don't think there's any putting the genie back in the bottle. And certainly, I would be nervous for us as a society if we did, because we know other societies and other countries won't stop, which means we further abdicate that leadership. The United States is an incredibly dynamic economy. And one of the reasons why the U.S. has continued to grow and to succeed is because of the way it rebuilds itself and the way it embraces these technologies. If you think about per capita income in the United States, and if you look at per capita income, and look at it from the advent of the railroads in 1870s to now, the interesting thing about it is it goes up around 2% a year. And you think, well, we've had all these revolutionary technologies, we've had all these incredible advances in society, but if you look at income per capita and you plot it, it increases 2% a year. So the question becomes, how can that be? Well, one question is, what if we didn't continually evolve as a society? We need these evolutions, we need these revolutionary steps in order to continue growing national income, because if we didn't, it would have stagnated and it would start to contract. And so I think we need to continue to evolve if we want to continue growing as an economy and being the most dynamic economy and markets in the world. So I think we need to do this, and so the optimistic side of me says we're going to create the jobs, we're going to find the paths that allow people to succeed while we're continuing to further develop AI. One thought is, and I was having a conversation yesterday with a very sophisticated private equity firm, and they were talking about how to best incorporate AI into their own investment process. And I suggested using AI as an enabling technology where you look at every single cohort at that firm, from the analysts up to the managing directors, and train up agents to support them at each of those individual levels. Because if I'm the CFO of that PE firm, or if I'm the CFO of a company, and I'm looking at my employees saying they're 10 times more productive with AI, right? Because we've trained up agents at every single level to assist them, and they become more productive. I say they're 10 times more productive with AI. I now face the question, do I go out and hire more people because they're going to be 10 times as productive? Or do I fire 90% of the people because the 10% that's left are just as productive? If I'm a CFO of a company, I'm going to be thinking about market share. And I'm going to be thinking about outperforming my peer group. And I'm going to take those more productive employees, assisted with their AI agents, and I'm going to go out and hire them, and I'm going to win market share. So I think it's about leaning into this.
Well, and I think they go hand in hand, because with AI, we kind of have the IQ figured out, but the EQ is what's missing. And that's where you need a human element to look over the data that's coming in, or how to deliver information. There's a nuance to it.
It's that constant pinging of quantitative versus qualitative, right? You got to have that qualitative finish to interpret what AI can't go into a store and see something live in action. That's
exactly it. It is the IQ for the first time in history has become commoditized, and the EQ is that judgment, those subtleties that we can harness and employ in order to produce the results that we want to produce. I think it's a super interesting point.
Yep, absolutely. And, one thing I wanted to ask, when we think about Zidle Macro Strategies, you have a few different business lines there. So who do you envision as your ideal client?
Yeah, thank you. So I've built the firm around 3 different verticals. Number one is senior advisory for GPs. And I spent almost 8 years in the boardrooms of Blackstone, where the decisions were made, and help those investment teams understand the macro and understand how the macro impacts their opportunity set. And so one vertical is working as a senior advisor to GPs. And so those are clients that have started their own private equity firms, real estate firms, credit firms, et cetera, where they don't necessarily need the full-time economist or investment strategist, but they do want someone who can help their investment teams become more macro sensitive. So the first vertical is for a small number of clients where I'm doing senior advisory. The second vertical is an outsourced CIO, where I'm working with RIAs, wealth advisors, and multifamily offices, and really helping them think through the combination of macro investment strategy, private and public markets, how they all work together, how you can blend them all in order to create better solutions for clients.
Is that going down to the asset allocation level?
Goes down to the asset allocation level. Exactly. And my experience on asset allocation is I have a couple sort of different perspectives on this. At Merrill Lynch, at different times, I ran both the tactical and strategic asset allocations. At Richard Bernstein Advisors as a portfolio manager and as a member of the investment committee, the team and I made decisions across those asset allocation verticals. And then at Blackstone, I oversaw the construction of Blackstone's asset allocation framework that blends private and public markets. And my experience, particularly in the last 8 years at Blackstone, is that the CIOs that I would speak with all pretty much came from public market backgrounds, as did I, and all sort of have the same questions in terms of how to incorporate and manage private markets on an ongoing basis. The sales training, the training for people to sell these things is phenomenal. But once you have private markets inside of a portfolio, understanding how they overlap, what are the unintended consequences, how do you deal with liquidity, how do you deal with J curves, how do you think about sort of liquidity with the perpetual capital funds. So working with RIAs, wealth managers, multifamily offices, helping them understand where these things sort of come together. And then, as you said, going all the way down to the asset allocation level. And then the third vertical is a subscription-based newsletter. I've written my entire career. I always write about investment strategy, macroeconomics, asset allocation, and thematic research. And so that's the foundation of my firm. It's the investment strategy, asset allocation, macro research. And then it's applied as a senior advisor or an outsourced CIO or directly to clients through subscription-based newsletter.
Oh, that's great. And where can somebody find the newsletter subscription if that's something they're interested in or any of your services?
Yeah, terrific. So they can go to ZidleMSG.com, and that's Zidle and then Macro Strategy Group, www.ZidleMSG.com. And there we've got examples of my research. We've got samples of the asset allocation, things like that. And then, of course, contact details.
Oh, that's great. I know I'm gonna check out some more of it. We like to end these episodes with rapid fire Q&A. So you can be as brief or verbose as you'd like. But I'll kick it off. We have a few questions here. One asset class you would be forced to own for the next decade. No trading.
Private credit. I think with the concerns around private credit, I think people have essentially kind of indicted the entire asset class for what are fundamentally bottom-up decisions, and they are not systemic. And in my mind, where people are looking for the exits, looking to sell their private credit exposure, it opens up opportunities for what I consider to be pretty good timing or pretty good buying opportunities. I would buy it. I would think about good private credit managers, and I would not look at it for 10 years. And if I had to bet right now, I would say over the next 10 years, private credit returns would exceed that of the public markets, just the S&P 500, pure beta. I think private credit beats it.
So this is like an inverse Warren Buffett bet. You take private credit, and I take the S&P 500 when Warren famously took the S&P 500 over hedge funds, right?
Yep.
How'd that work out for him?
Warren won.
Warren doesn't lose.
Well, again, it's Howard Marks in the beginning of all the private credit, and I think his comment was probably the most on point, which was the worst loans get made in the best of times. Right, and what you're seeing is out there is the people on the fringes. I think what you're talking to is the people who know private credit's all about. The opportunities there, the underlying credits haven't really changed, but there's been some noise. All right, Joe.
There's vintage risk out there for sure.
Absolutely.
But as I think about the asset class, you asked what I would buy, tuck away for the next 10 years. I think in the rush for people to sell, I think there's very good opportunities to buy.
I think that we can call that a conviction idea because I think it took less than 0.3 seconds for him to get that answer out.
Correct.
So very good, Joe. You passed question number one. All right, number two. What do you feel, in your opinion, is the most overrated economic indicator that people watch but should not?
GDP. It tells you what happened last quarter with a massive lag. It comes out, it makes headlines, it moves markets. It already happened, and then it gets revised. It gets revised a second time, and then there's a final revision. And the final revision may look nothing like the initial estimate. And again, it is telling you something that's already happened, and it's not even telling you all that accurately what happened.
I have an interesting one for you that came up on my LinkedIn today, specifically related to oil prices, and putting on your both historian hat and economist hat. Does today's environment, where the U.S. is a net exporter of oil, how does that change kind of the calculations when we think about the historical oil shocks of the past and what they've done to the economy?
Yeah, it's a good question. So where oil's role is minimized in the economy is not because of our role as a massive producer, but it's because of energy efficiency. We generally pick up energy efficiency every single year, somewhere in the order of 1.5% to 2% more energy efficient per year. So oil is just a lot less important to the economy today than it was in 1980 or 1970 or 1960. So energy efficiency helps to insulate us a little bit. But when it comes to oil prices, in some respects, it almost doesn't matter that we are the largest oil producer in the world. We produce more oil than Saudi Arabia. We produce more natural gas than Russia. That almost doesn't matter because oil prices are always set by the marginal producer, by the last barrel. So the idea that we're producing more of it than anyone else doesn't give us control over prices. The price is really set by that last barrel of oil that's traded. So in some respects, it should insulate us because we have abundant supplies of it. But the reality is we're not in control of prices.
All right, moving on. This one's going to be a little bit more like a humble pie type question for you. What's one market call that you got spectacularly wrong, and what did you learn?
Been so many, it's tough to count.
That was not the answer I was looking for.
My partner in investment strategy, so I worked alongside Byron for many years, and it was incredible to sit there and learn from him alongside him. And he was a philosopher, he was a philanthropist, he was an incredible investment strategist. And he would say, our job is to predict the future. He would say, my only goal is not to fail miserably. So failing is okay. Failing miserably is not okay. Biggest call that I got wrong and what I learned from it. When the Fed started hiking rates in 2021, 2022, the yield curve inverted. The yield curve historically had been the world's best economist. An inverted yield curve always led to a recession up until that point. Or yield curve had inverted 8 times and produced 7 recessions since 1960. So I wrote a report sometime mid-2022 said recession is coming. I was phenomenally wrong. I did a 180. When I did a 180, I titled my mea culpa report, Choose Optimism. It was a reminder that I'm an optimist and I need to, choose optimism. And when I'm unsure, just know that historically things go up and to the right. To be a bear, your timing has to be impeccable, right? Because you've got economic cycles that last 7 years, and economic contraction generally lasts less than 1. You've got, business cycles with profit cycles that are going up and down with much greater periodicity, but they spend more time growing than contracting. What I got wrong was every fundamental indicator in the economy said that the US economy was behaving better and it was more resilient, and that the curve was signaling something. And my interpretation was inverted yield curve can only signal one thing, that's recession. But the reality is if you zoom out and looked at the broader narrative, labor markets remained pretty robust. Corporate profits were still growing. They were going up and to the right. When you looked at CEO surveys, you saw confidence, you saw resilience, you saw optimism about the future. And so what I got wrong was I just focused too narrowly on one indicator and didn't step back and say, what are all the cards that we have that have been dealt to us, and what are they telling us?
Good answer. One book every serious investor should read, but probably hasn't.
Well, I mentioned Edward Chancellor's The Price of Time.
Not a lot have read that
history. Phenomenal history. Second one is Sebastian Malby wrote probably the best book on Alan Greenspan that I'd ever read. Obviously, we're just past the passing of Alan Greenspan, a legend, and his policies continue to influence the Fed to this day. Although it's communication policies changing under Fed Chair Warsh. But the book is called The Man Who Knew. And I think one of the most specific aspects of that book, one that still sort of resonates with me today, is how in the mid-1990s, 1996, Greenspan was listening to all of his contacts in the industry who were talking about the internet. And all of his contacts in the industry were saying the internet's going to change everything. It's going to revolutionize the economy. It's going to drive productivity and push inflation down. And Greenspan was so convinced, he went back into the Fed and told researchers to find supporting data that can prove how technology is going to drive productivity and productivity will drive prices down. And they couldn't find any supporting evidence. And Malby writes about this. Malby writes about how Greenspan's gut was so strong, his gut feeling was so strong that the internet was going to drive down inflation, that through the sheer force of his personality, he kept the rest of the Fed from hiking rates and ran the economy hot. So you had inflation that was accelerating in a robust economy, and you had Greenspan's faith that technology would be deflationary. Well, it wasn't. And you can look at the cost of compute. The cost of compute fell. The cost of fiber to the home fell. The cost of getting online via AOL fell. But inflation rose. And so that particular section of that book, I think it's an amazing book. I think people should read it, and I would particularly point people to that section.
And it's very timely for today.
All right, Joe, one last question. I know you don't have a 3 to 5 year plan. I hope you have one now at Zidle Macro Strategy, now that you're on your own. But if you were not doing what you were doing today in the world of finance, in the world of macro strategy, what would you do?
Well, I tried semi-professional dog walking when I was on garden leave. That wasn't for me. What would I do? I would probably write a book. I think I would enjoy that a lot.
I had my money on history professor.
Yeah, that would be up there as well.
Right on the college campus. Rooster,
Yep.
right? He could be the next Rooster.
Right.
Yeah.
So in that vein of writing a book, would it be a biography? Would it be about a period of time, or would it be pure fiction?
It would probably be history. And it would probably be a history of either the Federal Reserve, monetary policy, or maybe turning points in history. And if you think that answer is a little bit too quick because something is cooking, we're preheating the oven.
I was going to say, that was my next question. I don't know why your current job would stop you from writing that book.
I think that could be fun.
Well, we'll look forward to seeing that. I realize that can be a lot of work as well. Big undertaking. Joe, this has been a phenomenal conversation. I guess I will leave you. Scott tried to close the Q&A, but one thing I'd like to know, because I know you are a golfer. Favorite course you've ever played?
In New Zealand, North Island, TRI. It sits next to Tara Iti. Between Tara Iti, TRI, North and South, you've got 3 of the top 100 golf courses in the world, and there is not a more beautiful place than New Zealand.
We'll have to add that to the list.
Recommend it. And if anyone out there decides to go and you need a strategist to tag along, we can talk interest rates. We can do it.
Plenty of time on the plane over there.
Yeah, absolutely. That is not an answer.
How about Jason? Can I ask the question? Can I can I ask the question? Do you have a favorite golf course anywhere in the world, or Scott?
I'm sure Scott does.
Anywhere in the world. I mean, it's hard to say if you've had the opportunity to go and play over in the UK. I went to Scotland, and my favorite course, we were fortunate enough to play Loch Lomond, where they played the Scottish Open for many years. But just an amazing place.
I would have to say I don't have a favorite one. I know my least favorite right now is probably Oakland Hills South.
That's definitely the highest scoring one.
Yes. Yeah, high score is good. In that case, I did
Oakland Hill
excellent.
South, I think its numbers 10, 11, 12 there. I think are among the probably 3 best holes in any stretch of golf anywhere.
11's green complex is diabolical. Right, you got to come up over that ridge, and then it just rises up and sits on the top, and everything's pitch forward. It's the most beautiful place you go to torture yourself on some days if your game is not on.
I'm sure you should put it on your list. We'll have to get you out of here. And that's one last thing. You mentioned, in all your stops at your previous career, the Townsend Hotel in Birmingham, I think you spent the second most nights at.
I have spent probably somewhere in the order of 150 to 200 nights at the Townsend, and second only to the JW Marriott Grand Lakes in Orlando, which is where Merrill Lynch and Morgan Stanley, a bunch of the other firms, have their big conferences, their recognition trips for their advisors. So yeah, I've spent a lot of time in the Townsend, and Birmingham, Michigan is absolutely the most beautiful town that people have never seen.
Oh, that's a great plug for Birmingham.
Oh, absolutely a great plug. Again, it was a lot of fun, Joe, back in the day when we got to run around Oakland County when you were at Rich Bernstein, and a lot of foggy mornings maybe coming on after a night out dinner, picking Joe up and going to our next day. So it was always a fun time. We always had a great time traveling, and certainly well received. I recommend anyone read Joe's material. Go check out his website. I know you post a lot of stuff on your social feeds with LinkedIn. Incredible speaker, knowledge base. I think it would be doing yourself a disservice not to go check out what Joe has built.
Absolutely. Joe, thank you very much for joining us.
Great conversation.